Hello, this is Paul Paquin at Golden Financial Services. Today we're just going to have a little bit of a fun video. I'm going to show you guys how to use a stock screener. Okay, and I'm going to start with, let's start with our own stock screener. So I'm going to create a brand new one. You do have several to choose from. This is a Yahoo Finance stock screener. Okay, but we're going to create our own for now. I'd like to go United States, mid cap, large cap, and mega cap. So you can see on the right there's 3,676 companies in this list already. I don't care about the price. I don't care about the sector right now. I'm looking for either fair value or undervalued stocks that have low debt. With a financial crisis like what we're going through, we want to make sure that the company is not likely to file for bankruptcy, or we want to stay away from companies that have debt because debt can be detrimental to a company. So in general, we want companies with low debt. Let's start out here with the earnings history, and on this, we want to have at least low, medium, and high earnings consistency. We need some type of consistency in order to be able to make a projection for the future. With no consistency, how can you make a projection? So now just by doing that, okay, by selecting this criteria, we're already down to 422 companies. So that eliminated thousands of companies right off the bat. We also want to look at the revenue. Sometimes the earnings may be affected, like if a company is going to make an acquisition, that could affect the net income. So we also want to look at the revenue consistency. So we're going to select all of these. Now it's lowered even more, 392. Okay. Let's look at estimated revenue growth. Okay, whenever it's an estimate, I mean, this is based on what the analysts are saying. So we can take it into consideration, but let's use a conservative number. Let's use just 5%. Estimated revenue growth, greater than 5%. Okay, that brought it down a little bit more. Now let's add in here debt to equity. Well, we want to keep it under 1.0. I mean, you can pick whatever you want to pick. In my preference, low debt, we want to make sure that the debt is under 1.0 because it needs to be less than the equity. That's the goal. So we'll put, okay, this is asking for in percent, so we can say less than 100%. Now it brought it from 300 plus companies all the way down to 195. So we've just eliminated companies that have way too much debt to even consider. Now let's use the current ratio. This is a great one because the current ratio is a measure of a company's short-term working capital. So in the next year, short-term meaning that in the next year, the current ratio measures the current liabilities, meaning the debts and stuff that needs to get paid in the next year, versus the current assets, which are the assets that are going to get converted into cash in the next year. So this is short-term working capital. We want to make sure that the current assets are above the current liabilities. This is very important, this metric. So in this case, we could put greater than 1.0. 1.0. Okay. Let's actually make it 1.2. So brought it down a little bit more to 163. The next one we're going to use is the price to earnings ratio. Okay. It varies in industry, right? A price to earnings ratio of 15 may be high in one industry, but then in another industry, maybe 25 is considered high. So PE ratio, you have to compare it to other companies in the same industry to be able to tell if it's really priced inexpensively or if it's expensive. But generally speaking, we're not touching any companies right now that have a PE ratio of over 25. So we could put less than 25, and that knocked off more than half the companies. Okay? If the price of the stock is selling more than 25 times the earnings, that's expensive, and there's a good chance we're going to lose money at some point. Because no company can continue to maintain that high of a PE ratio forever. Just to give you an example, Apple's PE ratio fell under 20 during the pandemic. Okay, now it's above 30. So you can get really good deals even on great companies like Apple. Apple literally, their PE ratio was right around 20. That's when you stock up on Apple. So we're going to keep going. Let's do at least one more. So the problem with the price to earnings ratio is it only measures the past earnings and looks at the price, where it's missing something. What about the future? What about the future cash flow? That's how the company's going to grow. Do they have a way to grow their cash over the future? In the future? What we can do to look at that question is to measure the price to earnings ratio, but also with the growth included. So this one right here is the PEG ratio. It takes into consideration the growth as well. And if you can find a company with a PEG ratio of less than 1, that is ideal. However, 1 to 2 is good as well. Anything above 2, I'm not going to even consider. So let's PEG ratio less than 1. Look at that. Now we're down to 22 companies. If we include 1 to 2, we're at 31. So let's just include 1 to 2, 1 to 2 as well. Fine stocks. I'm not recommending any of these stocks that are going to come up here, but these are definitely a nice bucket of stocks to consider. And there could be some really strong buys in here, but there's no guarantee. You know, you have to open up this stock, look at the financials over the last decade or longer. You have to have an idea of what the company's going to do in the future. You know, is it like the Blockbuster video store where anyone could see that they were about to go out of business? Would you want to invest in a company like Blockbuster several years ago? No, of course not. So you have to look at both qualitative and quantitative factors. Okay, so I'm going to scan down here. You can see some insurance companies. You have biotechs. You have banking stocks. You have home improvement stocks. Mohawk Industries, they deal with floors. You have finance and mortgage stocks like Toll Brothers. So these are some great stocks. We can do another video in the future where we actually look deeper into each company, but this video was just an introduction to how to use a stock screener. I hope you all enjoyed the video, and we'll do another one in the future if we get some good feedback on this one. Thank you guys. Have a great day.